All right, welcome to The Explainer. If you're an international business and you're looking at Turkey, your financial planning for 2026 really needs to get started now. We're about to unpack the country's entire corporate tax landscape, and we're going to go way beyond just the official rate to show you the powerful strategies that can seriously cut down what you actually end up paying. Okay, so here's our game plan. We'll start with that big headline number. Then we'll dig into the difference between the sticker price and the real price you pay. After that, we'll open up the toolkit of tax reduction strategies, cover the must-know compliance rules, and finally, we'll wrap it all up to show you your strategic advantage. First things first, let's talk about that 25% starting point. We have to establish the official number that every single budget for Turkey in 2026 needs to begin with. And there it is, 25%. This is the projected standard corporate income tax. You'll hear it called CIT rate in Turkey. It's the official rate that's applied to a company's taxable income, and it is, without a doubt, the fundamental starting point for all of your calculations. Now, for some really important context here. This 25% rate isn't necessarily set in stone forever. It actually reflects some recent temporary hikes. So for any planning you're doing for 2026, this is absolutely the safest, most prudent number to use. But you've got to remember, this is just your starting point. It's not your final destination. And that brings us right to a crucial distinction. This is a concept that honestly separates the most successful foreign investors from everybody else. You have to understand the difference between the sticker price and the price you actually pay. Think of it like this. Over on the left, you've got the nominal rate. That's the official 25% we just talked about, the sticker price. But on the right, you have the effective rate, and this is the lower percentage you actually pay after you use the incentives and strategies available in Turkish tax law. Our goal? To make that number on the right as low as legally possible. So, the big question is, how do you do that? How do you actually lower that effective rate? Well, it's time to open up the toolkit. Let's look at the three main ways you can strategically slash your tax burden in Turkey. First up is, you could argue, the most powerful tool in the entire system, the Investment Incentive Certificate, or YTB. This is a government program, and it's specifically designed to encourage certain kinds of investment by offering some pretty significant tax breaks. And the impact here is just massive. I mean, we're talking about a reduced tax rate that can actually plummet into the single digits. Imagine paying just 2% instead of 25%. And on top of that, you can get exemptions from that and customs duties on key machinery. What's really key is that these incentives are often even better in less developed regions, which is a big part of Turkey's economic strategy. Okay, next up in the toolkit, R&D and design deductions. If your company is all about innovation and you do that work inside Turkey, the government offers some really powerful incentives to back you up. This is huge. You can deduct 100%, yes, you heard that right, 100% of your qualified R&D expenses directly from your tax base. This doesn't just lower your tax bill, it's almost like the government is subsidizing your innovation. Plus, you get these extra perks like exemptions on stamp duty and even on income tax for your R&D staff. The final major tool is for companies that use their base in Turkey as a hub to serve international clients. So think software development, consulting, design work, or any kind of technical support for customers outside of Turkey. And the number you have to remember here is 50%. You can get a 50% exemption from corporate tax on the profits you make from these services. Now there is one key condition. The payment has to be brought into Turkey in a foreign currency. It's a really direct incentive to boost service exports. So, unlocking all these incredible savings isn't just automatic. It requires mastering a few critical areas of compliance. You want to avoid penalties that could just wipe out all the benefits you've worked so hard for. First and foremost is transfer pricing. The Turkish tax authority looks very, very closely at any transaction between your Turkish company and its foreign parent or sister companies. So the absolute crucial point is this. Every single transaction has to be priced as if it were between two completely independent companies. That's what we call the arm's length principle. And to prove you're following the rules, documentation is totally non-negotiable. You have to prepare an annual local file and, if you're part of a larger group, a master file. If you get audited, this paperwork is your #1 defense. Seriously, not having the right documentation is one of the fastest ways to get hit with heavy penalties. You also have to manage withholding tax, known locally as stoppage.
This is a tax that your Turkish entity has to withhold when it makes certain payments, like for royalties, interest, or technical services to its foreign-related companies.
Now, the domestic rate can be as high as 20%, which is pretty significant. But here's the good news. Turkey has double tax treaties, or DTTs, with a lot of countries. And as you can see from this chart, these treaties can slash that rate way down to 10%, 5%, or in some cases, even get rid of it completely. Using these treaties correctly is a huge area for both compliance and savings. All right, let's bring all of this together. We've looked at the starting rate, we've seen the tools to lower it, and we've gone over the rules you have to follow. So what does this all mean for your strategy in 2026? If there is one single thing you take away from this entire explainer, let it be this: that 25% rate is not your destiny. It is simply the ceiling. And the gap between that ceiling and the much lower rate you could be paying, that is filled entirely by strategic planning. At the end of the day, achieving a competitive tax rate in Turkey is a direct result of being proactive and strategic. It's about using those YTBs, taking advantage of the R&D deductions, and managing your compliance like a pro. It's not about just passively accepting that headline number. And that really leaves us with one final thought as you start preparing for the future. When you build your financial models for 2026, are you budgeting for that 25% ceiling? Or are you planning for the opportunity to achieve something much, much better?